Our next guest says the Fed's strategy isn't just a policy error, but a Ponzi scheme.
A new article explains the new buzzword Web3 and breaks down what the upcoming online era could look like.
Look, I think that a recession is almost inevitable.
Put simply, DeFi gives financial freedom back to the people.
Hey guys, this is the Alpha Drop podcast, which is presented by New Order and focuses on DeFi and macro analysis. I'm Contento. I work on the community/marketing side at New Order, and we're joined by, as always, the two Chads, BlkSwan and Mitch.
Hi, this is BlkSwan. I'm a fund manager outside of being a contributor at New Order and Frogs Anonymous, specialize in derivatives and multi-strategy, crypto, and traditional theme investments. Here at New Order, I focus on treasury management and macro themes.
Hey guys, my name is Mitch. I am focused on researching here at New Order, so pretty much coming up with new ideas for us to incubate in the DeFi ecosystem.
The Alpha Drop podcast is brought to you by New Order. New Order is a community-led incubator DAO that builds startups at the frontier of decentralized finance. We incubate and launch projects while accelerating early-stage DeFi protocols. New Order acts as a co-founder and works directly with teams by leveraging and deploying our network of developers, researchers, and business development experts. Our vision is to create the next generation of DeFi protocols by building alongside future leaders in the space and contributing intensively to innovative projects. If you're a founder looking to work on a new project or a builder looking to get involved in the DAO, head over to neworder.network to get started.
Welcome back, everyone, to the 5th episode of Alpha Drop. We're going to get into some stuff now. Yeah, BLK, what do you think about the latest CPI read? I think we have FOMC at 2 o'clock. So, yeah, roughly a little bit more than an hour. What are your thoughts on that? What are your thoughts going into 2023?
We just had our CPI report yesterday, and it came out cooler than expected. But one thing I really want to point out is we're still up 80% on the price of oil for the year, right? Eggs are still up, 30-something%. And so when you look at inflation, it hasn't actually gone down, right? And that's the big point I want to really make here is that, sure, month over month, it wasn't as high as everyone thought it would be. It wouldn't kick up higher, but year over year, we're still absolutely getting crushed by it. And really the big point to that is look, the average American doesn't care month over month, right? And in fact, it doesn't really benefit us in the long run. The question is, if inflation is going to be this sticky, right? How long can the average American, the average person last with it at these elevated prices? And if Powell, who's going to come out today, and it's expected that he's going to be a little bit more dovish, they're committed to a 50 basis point rate hike. That's what the consensus is. But I expect the tone to be still a lot more hawkish. He might even say that, look, even though we're going to be cutting it by 50 basis points because we're seeing some positive effects, we're even going to push the end goal of the hike higher than we previously thought before. And he'll push that same narrative. And it's really to drive home this fact that, he's committed to killing inflation at the end of the day. And and the only way to kill inflation is to trigger a recession. But if we trigger a recession, we're not killing inflation the healthy way, right? You're purposely causing pain rather than fixing the problem, which the problem is we need to produce more goods. And that's the one thing we have yet to do is we're not turning on pipelines. We keep on, Biden just passed another law to turn off more pipelines, right? We destroyed Nord Stream 1, which is being used to, send oil over to Western Europe. We're doing everything else that should be done to cut back inflation. So my view of the talk today is he's going to stick to that 50 basis point rate hike, but he's going to come across tone-wise a lot more hawkish, come down a little harder. And I think for 2023, we'll, as far as macro goes, we're going to see kind of a day of reckoning of what's going on in Europe, probably in the end of Q1 and Q2, especially after Europe goes through its winter. You're going to see how much of their oil and gas supplies they really use up. So either they're going to convey, Ukraine and say, look, Ukraine, you gotta surrender, right? Because we can't take any more of this, and we want to do trade with Russia. Or you're going to get to the point where Russia's like, okay, we're fed up with this. We don't want to do this war anymore. And it's been a year and a half, right? So either that's going to happen, but the rest of 2023, you can bet we're not going to be anywhere near a bull market unless the Fed completely reverses policy. We start seeing, them start pumping the market with more cash, and we're not near that. At these prices today, it doesn't make sense to me, and a lot of people are, they're gawking at markets. I mean, look at the housing market, right? For example, does it make sense that you pay, and I love seeing this meme the past, couple of weeks, you're paying, $800,000 for a below average looking home, with, 8% interest rate. Like, and the median income in the US is like $57,000 a year, right? You're essentially spending your entire salary on your home. That makes no sense whatsoever. So when you're looking at markets, it's something has to give, and it's either going to be that consumers around the world are going to get a pay increase, right? Which I don't think is frankly going to happen. Maybe slowly, but we're heading into a recession, so doubt it's going to happen. Or prices around the world have to come down. So the more likely scenario is prices around the world are going to have to come down. So a lot of these people who have their real estate portfolios, they're probably going to be sitting tight on the real estate for another couple of years, maybe 3 or 4 years, before they might see a turn of profit. I think 2023 is just going to be the ugly year. I think that's where we'll probably bottom out, maybe sometime in Q4, but I don't expect them to be able to continue kicking this can down the road. That's my view of what's going to happen. But there is a glimmer of hope. I know it comes off bearish, but there is a glimmer of hope. So like, should probably preface that is like I want to point out is it's going to make way for a lot of crypto stuff. I don't know. I want to touch on the FTX thing because it's been the most entertaining thing to watch the past month or so. I mean, regulators are not even regulators, but people in the Senate, senators are pushing for the fact that, well, let's separate the man and the technology. I don't know if you guys saw the hearing yesterday, but that was a major theme that was pushed, which is kind of not by Maxine Waters, but by other senators, was separate the man from the technology. Because, we had, in the history of Ponzi's, in the history of fraud, we've had legitimate technologies. So there's a railroad company back in the day that they sold another competitor's railroad company that they didn't even own to someone. And it was one of the biggest history of frauds, but we didn't demonize railroads, right? So that's how they're looking at this situation, and I think it's healthy, right? So you're going to see a lot of these bad actors get wiped out in this recession because they won't be able to keep it up. You're going to see a lot of the companies that are not able to compete get wiped out. But why this is a good thing, and I think over the next 2-3 years is the best time to start a business, because they're going to have some sort of customer base, right? These companies are going to have some sort of customer base, but they've just been inefficiently managed. For a person to get in there, take over the company for cheap, especially if the company's going through bankruptcy, and then fix it up. I mean, that's really what's going to be the move. And so I would look at it. I'd look at the market from that perspective. Is if you're new coming into it, you have the most potential for disruption. over the next 2 to 3 years. More potential than you probably would have ever had at any other time. Yeah. So
Sorry, go ahead.
no, what were you gonna say?
I was gonna say that padded. I think that padded the bearishness quite well.
Yeah. Well, I mean,
it's not even bearishness. It's just like maybe more so the truth.
Yeah.
Because I mean,
yeah.
Yeah, I mean, I would agree.
Yeah.
I mean, it seems like, yeah, I mean, the FTX situation, you know, it's not ideal. However, it was inevitable, right? Like these guys use QuickBooks for their accounting. Like how, you know, like how crazy is that? They didn't have risk management or anything. And, you know, although the sort of implosion or I guess like contagious effects will affect like all these other companies that leverage them, but you know, it's something to, I guess, like learn from and be like, okay, you have to do diligence on your partners. Otherwise, like these things can happen, you know? So inevitably it will be, you know, a positive for the space long term, but in the short term, obviously the effects are quite detrimental. I mean, I'm kind of curious as to like what you think on like who comes out of this, you know, with a better outlook, right? Like who wins from this situation? I think the clear answer is, you know, governments, you know, because now they have like a strong example to point to as to why crypto should be monitored and regulated by centralized governments and forces. And they can, you know, and then they can sort of build up that trust, and inevitably then, you know, they're probably developing like CBDCs in the background and being patient on when they're going to roll them out. So that kind of then begs the question in the future, once they do roll these CBDCs out, are those going to be like the stable coin killers, and then really crypto is just going to be centralized by these governments?
Well, I think you make it's an interesting thought. Will this be the stablecoin killer? And I think they'll probably partner with the stablecoin companies, but the stablecoin companies will be adopted as they'll pick the strongest one, obviously. So they'll be like USDC, you know, you have such a good customer base and you already have the platform built out. So, or the integration for Ethereum or whatever, right? So we're just going to use you, right? We're going to license everything to you, and Circle is going to become a government agency, right? And that's what I think things will kind of lean more towards. But you're definitely right. Like the feds are going to use this as an excuse to regulate, which I will say, like, I mean, they should to a certain extent. I was on a call right before this, and the guy was one of my clients' dads, and he was trying to get involved in crypto and DeFi, and he got into this thing called Drift Network, right? And if you go look up Drift Network, it's another one of those Wonderland Fi type of freaking, you know, rebase tokenomics Ponzi things. And I'm like looking at him, and he's like, I'm having an API issue. I'm not able to, you know, trigger into this thing and to get in and access it. I was looking at it, I'm like, well, the API issue is not you, man. Like that's someone on their internal team forgot to like raise their API limits, or they haven't paid something. And I'm like, it's probably a dead project. And when you go look at this, it's on Binance Smart Chain. It's like it has an infinite, you know, max total market cap, because it's a rebase token. I mean, it's ridiculous. Nothing's happened with it. And it's like, you should probably have some sort of securities regulation to keep people like him away from stuff like this, right? And the whole idea behind a regulation, and I think that a lot of people in the tech space particularly have this kind of negative view around regulation, because the motto of the tech space is move fast, break things, and solve problems. Regulation prevents you from doing that at a quick pace, but regulation is really best practices. And personally, because my firm right now is going through and getting a broker dealer's license, right? It's a 180-day process. And they have to interview you over that 180 days. They have to do background checks. They have to have access to your bank accounts to see what transactions you made over the past, however many years. They interview your family. Like, it's extensive, right? It's very extensive. But of course, you're operating in the securities industry and you're about to do something that potentially can lose people their livelihoods, So you should know who these people are, right? The SEC should know. But like some of the guys on our engineering team are just sitting there and they're like, oh, I don't know about this. This seems like a hassle. And they're messaging their buddies on Silicon Valley and people who work in the blockchain space. And they're all telling them, don't get it. It's not worth it. It's just a pain in the ass, an onerous task. But, and when you look at what you have to do, you literally have to get this. This is what regulation takes. You take securities exams, which, by the way, if you work in the traditional financial industry in the US, you can take all the security exams you need in 4 months. That's it. They're not hard. They're easier than a college exam. They're pretty freaking basic, right? Knock them out. Once you're done, you create a business plan. You submit the business plan. The business plan gets approved by the SEC. Now you're a regulated entity. And that's what these guys are complaining about. So it's like, look, I get I understand the headache around regulation, but a lot of it is overblown. And if you're bitching about creating a legitimate business plan, right? What are you going to do in case a customer decides to sue you, right? Where are the records to prove that you're innocent, right? For example, you should hold records for 6 years, statutory limitations, right? That's just good business practice. And that's the thing that a lot of these crypto places, a lot of these tech guys are bitching about. And I think it's overblown at this point. It's not a valid excuse.
Yeah, I definitely think like regulation is important as long as it doesn't significantly harm innovation. That's, I guess, like the main concern. What I'm sort of interested in this like long-term outlook is, some governments are going to be, have very stringent regulations, whereas others might be sort of lax, right? And if the ones who don't have strong regulation, those are going to be the areas for, you could say like more innovation. Some of that innovation could be harmful, right? But then there's going to be a large user base that gravitates towards those areas. And then when they settle into fiat, this is just a thought I had, when they settle into fiat in these other currencies, is that going to boost those governments relative to, say, like the US, who is more strongly regulated?
Yeah. Oh, definitely. I mean, if you look at why the US, why is it that we attract so much capital? And I mean, you're going to have those little niche areas. Well, actually, I take that back. Look at the Bahamas. Why is it that Bankman-Fried chose the Bahamas of all the different places to conduct business, right? And they are generally more lax with how they do things. So yeah, you're going to get that to happen. Like that's why a lot of Russians do banking in Andorra. And for those of you who do not know where Andorra is, it is a little country right between Spain and France, a little ski resort town. But they do banking there because they don't ask questions. So like that's like when you have those countries appear, you're going to have the big money move over to there and do stuff out of there. But for the average little guy, I don't think so as much. But yeah, you're definitely going to create these little hub zones. If you even look at like Singapore, right? When Singapore converted to capitalism, they became this thriving nation really quickly, right? And it's because they created more lax rules, but then the types of regulations they enforced were regulations that made sense. So there's a difference between good regulation and bad regulation. Like bad regulation is what some countries do, like China, right? Or where they completely they say, no, you can't do this unless you have government approval, right? Whereas good regulation, you compare it to the US, where we say, well, look, you can do it, but disclose what the risks are, right? What is it that's going to happen? As long as you keep it like that type of regulation, I think it's good. I think it's very good. But and that's the big thing. That Michael Saylor video I shot to you the other day. Did you watch it all?
I watched the clips and kind of like skimmed through it, but is there a particular section you're pointing to?
Yeah, so it's about like halfway in, he makes a really, really good point. He goes, look, like a publicly traded company, for example, when something material happens, they have to disclose it within 4 business days, right? So take the Celsius incident, or was it Crypto.com, who like they sent someone, they like lost $500 million, right?
Yeah.
Like, but they waited a year to tell people, and they're like, oh, we had a boo-boo, right? That would have been disclosed 4 business days from it occurring, right? And then investors would have been able to price it. And in my experience, and the reality is that investors know how to price risk, but we have to know what the risks are. We look at what happened in 08 and all these scenarios where things blew up, we blow up from things we don't know about, right? It's not from the things we do know about. So as long as we're aware of what the situation is, we know how to account for it. And that's why I feel like if the regulation I could probably expect to come out of this will be more so, getting crypto on the same page, treat it like a security where it's more going to be, please just disclose what you're doing, right? And as long as they do that, it's not as big of a deal. But if they tried to say the government has to approve your projects and all this other jazz, then yes, there's going to be problems. There's definitely going to be problems. Yeah. But to check out that interview with Michael Say, it was on whose podcast was that on?
Patrick Bet David, I think.
Yeah, he makes some great points on there as to this whole FTX situation. It's like, if they were a publicly traded company, they would have to disclose all this stuff. And that's the thing, is that these privately traded companies that operate pretty opaquely, they don't have to disclose anything, and that's where you see most of the crimes, most fraud happens in that situation. So it's
Yeah, so I guess porting over to the space that is currently unregulated, which people are concerned that will be regulated, is in talking about some of the major developments happening in crypto. Oh, Contento, your mic's not working.
Hello?
Yeah.
I'm just gonna switch mics for a second. So I've been trying to ask. So before I kind of want to circle back on markets, just because there's one kind of topic that I want to cover there. But before we do that, I do want to ask: are there any entities that are DeFi native, or maybe DeFi native isn't the right phrase, but something that allows you to circumvent centralized exchanges? So instead of me going to a Canadian centralized exchange to basically onboard money into self-custody wallets, is there a way for me to do that so it's like I'm basically but I guess not, like I'm trying to,
It's not through a centralized exchange.
yeah, like is that
better
but I mean,
onboarding?
in the end, yeah, like something that's just more like, I guess, decentralized, but like how would that even be possible? Like, I mean, from bank, like there's always going to be a third party. There's never really going to be a way that it's like, or not never, but as it stands, I don't imagine there's going to be a way for me to transfer from my bank to kind of quickly get into
it's I mean, it's possible, but it's like once you go to fiat to digital currency, that fiat needs to be stored somewhere, right? So like you can have a digital representation of it that might be stored in like a sort of smart contract. But I mean, I agree with you in your main point in that there needs to be better onboarding solutions, and I think that's kind of being worked on. We saw like Stripe is moving towards that direction. I mean, MoonPay, forget the names, but there's some like other projects that allow you to onboard directly through fiat without going through a centralized exchange. But I mean, essentially, it's just like it's the same process. It's
And
just you're not able to trade directly, between currencies, like
it's
on those projects, right? As you could with a centralized exchange.
that would still be kind of a centralized exchange though in the end. So it's kind of like
Right.
you might as yeah. Okay.
But it's less risky, right? Because it's like you then don't have the users are safe to know, like, okay, there's a limited chance that this centralized entity is, commingling with my funds. It's more risky in the centralized exchange because, that's what they do, right? They constantly are moving around, funds to supply for customer withdrawals and whatnot.
Well, really, Contento, you're talking about a clearinghouse. Like their job is to say, all right, dot the I's, cross the T's. You took Bitcoin, turned it into cash, or you took cash and turned it into Bitcoin. They just record that happen and make sure the money is settled and it is where it is. So you're always going to have them to a certain extent, right? And you have to have them just because you're moving between different systems. It's like when you try to switch, like think about it this way, you're trying to switch Canadian dollars to US dollars. Who do you have to go to do that?
Yeah, it's true.
You're switching just an entirely different system. So you're always going to have that middleman whenever you do that switch. I just think that they're, at the end of the day, they might make it more expensive. I don't know. You might get a situation where you have like, you walk into an airport trying to get into another country, and you have like those currency vendors there, and they charge you like 25% each way to like swap into another currency. You might get that with Bitcoin, right? And that's kind of how I see. That's one way of seeing the world working. But
we do have the Bitcoin ATMs. There's actually quite a few in Toronto. I haven't tried them though. I want to try one just to see. Because I'm curious.
They charge you really high fees.
Yeah, I figured.
Yeah, that's one hell of a business.
The other thing, okay, so then I do want to circle back on this before we maybe wind down some discussion around the markets in general, but I do want to talk about the echo bubble theory that's been kind of, I wouldn't say that it's very prominent on CT right now, but I know this is not a new theory in markets in general. So, I want to know, I want to know your thoughts on, what are the possibilities of a echo bubble? And, in general, what are some historical echo bubbles or like, what do they actually look like? Is it just some like BS?
So just to clarify what you mean by echo bubble, are you talking about like there was a bubble in one market which then pops and then spurs a secondary bubble in the same market or in another market?
No, in the same market. So like an echo bubble would be, we just had, the run up to 69K. The echo bubble would be a secondary, very, very small bubble that is like an echo of the main bubble to the run to 69K. It would be like, running to 40K or something. I'm talking about Bitcoin. It's almost like a dead cat, but I guess with a better marketing name. It's like, I don't know.
Yeah. I think that echo bubbles, I think they really depend on how you slice your time frames. Because I'm just trying to think back, like if you look at like the tulip mania, for example, that happened in Deutsch, in the Netherlands and whatnot. I mean, when that popped, that was it. But if you look at it from an extended period of time, tulips have consistently increased in price just due to inflation. But I look at it this way: is that the echo bubble is really the final leg up, and so again, it depends on when you slice your time frames. So you could argue, for example, that the echo bubble was in 2021, where things came down that July and then they popped back up, and now they're coming back down again. That could have been the echo bubble, right? And so it depends on your time frame. Or you can say if you go from a longer time frame, I mean, the echo bubble could have been from the 2021 run up to that was an echo bubble for the 2017, 2018 run up, right? So it depends on how you slice the time frames. I mean, I would say housing is probably in a little bit of an echo bubble. Tech companies are probably in a little bit of an echo bubble. The .com bubble to today, right? Or for example, housing 08 to today. Prices at these levels are not sustainable with an 8% interest rate, right? Prices probably have to fall another 20, 30% in order to be at a sustainable level. So, and I want to make this clear: if interest rates keep increasing, which for those of you who do not know, and you can go check your history, or if you have boomer parents, go ask your boomer parents. The prices at which, or grandparents by that matter, interest rates on average are between like 12.5% to 22% for homes. So that's a big reason why they're able to buy their houses for like $50,000 a home. Is interest rates are so damn high. Because really interest rates they're a function of what people can pay, right? Like what's a livable wage and what they can pay. And so this idea that like, what's his name? Who's that dude? The dude who did WeWork? Adam something.
WeWork.
You guys know who I'm talking? Adam Newman.
I know WeWork.
Yeah, Adam Newman. That's the guy. So he started a new company called Flow, I believe, or Carbon, something like that. But their entire premise is they're going to buy up a bunch of real estate, and then they're going to create these shared living community experiences, because their theory is that people will never be able to afford homes. So we're just going to rent them to you. And then, by renting them through us, you can do like a share lease joint agreement that over time you can own the home as you pay it off. But that's how they're going to go about doing things. Which that theory works to a certain extent, but that also assumes that, someone who's like, well, I'm just going to start building a bunch of new homes and take advantage of the fact that I can sell these for a high profit, right? You're completely disregarding the fact that you have an effect on supply, number one, and then two, there's going to be other people who are out there who want to take advantage of that. So, and also it ignores the fact of interest rates. What if people can't afford the rent that you're giving because they're not being paid enough, A, and B, what if they can't buy the homes because the interest rates are too high? Well, the prices have to be affected. And that's when push comes to shove and prices have to be changed, they will change. And that's what a lot of people don't understand. That's where you get that secondary bubble kind of really kicking in, is on the downturn, reality fixes the situation.
What happens if we get a 25 basis points hike at 2 p.m.?
I don't think we will. Like, you'll probably see the market rally, but again, the Fed is pushing this narrative that, we need to kill inflation. And the only way to kill inflation is to raise the cost of borrowing money to make it expensive. You have to decrease what the bank can loan out by raising the reserve deposits, and start selling debt back to banks and say, we're taking your cash available for you to loan out. And why they would do that is it's the only way to decrease inflation. Inflation is literally just what's the growth rate of money supply coming into the economy from the Fed, right? Mm-hmm. If we cut that back and start taking money out more than we're pumping back in, well, now you're going to slowly kill inflation. Now you get deflation. So prices start coming down, start reverting. And so if they did that, you might see a little bit of a market pop. But again, their narrative at the end of the day is we're killing inflation. So here's the long-term goal. What if 2023, the goal is really, we're going to take interest rates up to 8%, right? Sure, we're only doing 25, basis point hikes, but we're going to be committed over the next 2 years to taking interest rates all the way up to 8%, right? that would slaughter the market if that occurred. And that's the thing that they said at the last meeting is 5% is not the goal anymore. It's more like 6 to 7%, right?
Wow.
So now you got this problem so I'll give you a great example, right? These real estate agents today are pitching to people it's called a 2-for-1 interest rate program. So what happens is this, and you go buy a home. My brother just bought one in Seattle, $850,000 home, 8% interest rate, like 7.95%, but 8% interest rate. And here, like, okay, works at Amazon. Him and his wife do. They make good money, right? But here's the problem. This 2-for-1 deal says the seller pays the first 2% of your interest rate the first year, and then they pay this next 1% of the interest rate the second year, right? So they artificially lower your interest rate, but with the hope, you're hoping that you'll be able to refinance at a lower rate, right? Here's the question: what if interest rates never go down, right? What if they keep going up? Because inflation doesn't die, inflation's too sticky. Well, now you got a problem. And that's the thing, is that if the Fed, they're left with this choice of whether they want to be in the stagflation market where you have sticky inflation and kick that can down the road as long as they can. Eventually you do have to go into that recession. But the real question is, how long do you want to kick that can down the road, or how long can you kick that can down the road before you absolutely wreck everyone in the market, right? Because I could tell you, my brother can afford to pay that for a couple years, but they're expecting rates to go down to get a lower payment. So if rates, yeah,
basically, definitely not close to the end of the bear market, not really close to a bottom. And I mean, an echo bubble possibly already happened. Yeah, that is an interesting take. I mean, I think we can kind of shift over now to, what are some cool projects that you guys are, playing with, that are in beta, that are close to beta. Do you guys have any cool projects on your radar?
Yeah, I mean, just like, I guess in general, some like major developments that are occurring that people should be keeping close attention to is just looking at Ethereum. There's innovations happening on the protocol level with protocol upgrades, like account abstraction. I think people are underestimating the ability of that. Like think of all EOA wallets, like your MetaMasks, they're externally owned accounts, like all of those are going to be turned into smart contracts, essentially, right? And Argent is like actually the leader in this space, and there's going to be more that are developing smart contract wallets once account abstraction is baked into that protocol layer. It just allows for so much more customizability, user ownership. Users will be able to pay gas in whatever ERC20 token they like, right? Like those are just a few of the benefits, but I think people should keep an eye on that. It is a ways out, but developments are being made. There's some cool like middleware projects that also keeping an eye on, like gonna like fit this, the modular blockchain thesis. And one of those is Eigenlayer. A lot of people have been talking about Eigenlayer. Eigenlayer, yep. Yeah, so basically what it is the problem it's trying to solve is that, I guess it's a couple, right? So one, there's a cost of capital problem in Ethereum. Stakers take on a significant amount of risk, and they are rewarded for that. Like 96% of total rewards, block rewards, are actually allocated to stakers, right? But they have no ability to choose effectively like where they want to stake. So for example, for a lot of these middleware protocols, like say like Oracle's Chainlink or some of these bridges, right? They all run on their own security, like validator set. And there's no shared security layer for any of them, which is a very big cost problem for all of these projects, as well as for like users. They can't, just choose, okay, I want to give you use this token to provide security for this middleware protocol and this one, it's like all separate tokens, right? And what EigenLayer does is it solves for excuse me, it solves for that middleware security issuance, capital cost of capital problem, and like node operator computational like constraint problem through ETH restaking. So you stake your ETH for base layer infrastructure security, right? And they're allowing you to rehypothecate that staked ETH to secure then EigenLayer, which acts as like the middleware security layer, essentially. Whether or not this works out is to be seen. But they've honestly like caught my eye and a lot of others eye because of this is a problem, and I think they have the right approach to it. But I mean, there's various issues with that I foresee that in the approach they're taking, like allowing users to leverage staked ETH to secure, say, like chain-link nodes, but also secure, say, like a ZK bridge. What happens if a chain link like Oracle goes under? Like what happens to the staked ETH that's securing the ZK bridge then, right? So they're allowing you to kind of like leverage your staked ETH in a way that may become inherently risky, but I guess we'll see. In terms of like in DeFi, some projects I think are pretty cool that have been popping up are in like the option space. Panoptic and Perennial really stand out to me. Particularly, I like Panoptic's approach, and it's developed by, I want to say, Guillermo and Jairus. I think he's like, is that who it is? Yeah, I think that's who it is. He's like the head of crypto at Bain, I believe. But the approach they're taking is they are saying, like, complying with the thesis that there are already these, DeFi base layers. So you have like Uniswap, MakerDAO, Compound, right? And these are the big players that control most of the liquidity in DeFi. And they're not trying to necessarily compete with them, but leverage their liquidity and the moat they've already built. So they're leveraging Uniswap v3's liquidity moat to build options positions for users. And I think this sort of like thesis will extend out to a lot more projects, and a lot more projects will realize this. They'll just say like, hey, it's very difficult, especially in a bear market, to bootstrap liquidity and build up that liquidity moat. But we have an innovative, solution for, some particular use case here. Why don't we just use the nature of composability to our benefit, be composable with these large players, leverage their liquidity, and make a better like execution environment for our users.
So I got a question. When you say leverage the liquidity, can you kind of clarify on that a little bit?
Yeah. So, I mean, like for the example with Panoptic, really, there is no, the Panoptic itself doesn't have to like source liquidity necessarily, right? All of these positions are done by opening and closing positions on Uniswap v3. But Panoptic is like almost kind of the environment in which you transact with, but all the execution occurs on Uniswap v3.
Oh, so
it's like they don't have to. So take like GMX, for example. GMX, I love their tokenomics model, but they source all the liquidity, right? Like they have liquidity providers, and all the trading is done through GMX.
Yes.
And through the GOP.
The
liquidity providers are essentially just like the liquidity providers on Uniswap, right? And they're just leveraging that via that. So
they get deeper liquidity.
Exactly.
That's genius. Oh, okay.
Yeah,
okay.
I could see, I like that approach, and I think that approach is definitely gonna catch the eye of a lot of these other projects. I mean, to the previous point, it's like how we're in a bear market, right? Like a lot of people aren't transacting with DeFi. So it's extremely difficult to actually bootstrap liquidity, right, and compete with some of these bigger players. So why not just leverage the ability or the liquidity moat for these players?
Well, that's such a so this is it feels like we're rebuilding a new financial system in crypto, but why it's really smart is people already trust Uniswap, right? Now you don't have to cross your fingers that this team isn't gonna, take your liquidity or whatever. You're literally creating a modular system like we have where, we have the market makers and there's Uniswap for you. And then now you have a broker dealer and that's this Panoptic, right?
Yeah,
Operating.
exactly.
And that's smart. That's really smart actually.
Yeah, exactly.
They're in beta right now, or?
Yeah, they released a white paper in the
Okay.
beginning of the year, somewhere around that time. I think I just saw an announcement of their seed round. They raised like 4.5 million from some pretty big players, but
Thanks. Yeah, I'm looking at their docs page right now. Wow, that's genius. This is cool. I'm gonna keep my eyeball on them. This is I think that the next phase of DeFi is really, we're going to take the big winners from this DeFi round, freaking Uniswap, Aave, all these guys, and we're going to start consolidating applications or protocols that can kind of leverage them and take them to the next step, right? And so you're going to get this new economy just coming out of it, and like this, I had no idea this existed. I mean, this is actual innovation. Like, I feel I would say for interacting with this than interacting with a new protocol that says, yeah, we do a new type of GMX protocol.
exactly. I mean, and they're just like reducing friction. I mean, I like your analogy of how, a lot of say fintech platforms are almost like the broker dealers. In this case that makes sense, but instead of having to go through, humans and, a bunch of loopholes in order to actually make that happen, in this case, these projects are just leveraging the nature of composability, that blockchain is inherent, and then they know these projects don't have to go through all of those loopholes, right? They just use an adapter through code, and then they get all the benefits that come with it.
Oh, this is a cool one. I like it. I like it a lot.
What's their Twitter again?
It's Panoptic XYZ _ XYZ. Only 4,000 followers. Oh man, here we go. See, this is what I like to see. Interesting project, actual use case, 4,000 followers. Oh yeah, it's a good time to hop in.
Ooh. This is a good one.
Yeah, this is a real good one. You really got following. DeFi advisory. Of course, Tins is freaking following these guys. Tins, if you're listening, hi.
Yeah, I had a topic. I don't know if we want to cover it, but possible airdrops.
I mean, look, I don't know. There will still be airdrops. My sort of, I don't like airdrops. I think it's pretty much just free marketing, and I don't think they're that useful. There was actually analysis done by some people in our community that they analyzed the effectiveness of airdrops, and it turned out they're not really effective at all. Sure, it builds up hype in the short term, but is that hype sticky? No, right?
No. Yeah.
Most people just sell the tokens right away. So I definitely see airdrops dying down in the long term, but right now in a bear market when these projects are struggling with accruing a solid user base, there likely will be more airdrops.
So I have an interesting question to pose to you guys. It's a little bit different from what we're kind of going over, but so given what's going on with FTX and all this other stuff. Do you guys think that Ethereum's move to proof of stake will have jeopardized its potential commodity status?
What do you mean exactly?
So the SEC a couple of years ago, the guy at the time during this Ethereum case said that ruled that Ethereum was a commodity, but that's when it was proof of work. And so the question is that, you know, we had all these new proof of stake coins come out, like Avalanche, Solana, all these different proof of stake coins kind of come out. And Ethereum moved to proof of stake, you know, citing, you know, we're moving for environmental reasons and all this other stuff. But, you know, the beauty to proof of work is that it turned energy into like a service almost, right?
Mm-hmm.
And so my question is that, given what happened with FTX, because FTX was really, they pushed Solana pretty hard, saying we're pushing the system, it's proof of stake, it does, you know, all this other stuff, it's better for environmental reasons. Do you think that, you know, this proof of stake movement might have jeopardized Ethereum's status as a commodity, given that the same amount of energy and work is not being done now?
So basically, are you saying that Ethereum was kind of basically a commodity before, and, you know, what would it be considered now? Because I heard some talk about the SEC possibly considering it a security or something like that, but I'm not very well versed in that.
I think the true commodity is block space, and I think the physical, like the asset that represents that most closely is staked ETH. I mean, comparing that to your analogy of energy, it's like, okay, block space is finite in a given block. Staked ETH is securing those blocks, right? So that's going to be the commodity for Ethereum. I don't know if the ETH token itself, it may represent the security in the SEC's eyes, but, you know, the block space commodity is really the most important part, and that's really why we have all of these, you know, scalability issues and all these projects coming out to increase scalability, is really to build better execution environments to optimize for that finite block space.
Okay, so interesting. So with block space, so is there a way to monetize block space then?
There's
maybe it's a dumb question, but
no, I've actually seen projects trying to build like block space derivatives. I have to see exactly what it, I don't know, I can't find it right now, but it yeah, I think then the kind of like the question lies in like who owns the block space, right?
Yeah.
So who owns that commodity, and and then, you know, who has the ability then to sell it, right? I mean, you could say like the validators, but then you're giving too much centralized control for the validators.
Yeah.
But I think that's like the purpose of, you know, proof of stake. It's right, you're staking your ETH that gives the validators the ability to accrue rewards, right? But the staked ETH represents kind of like this block space commodity that is decentralized across all of the users who decide to secure the network. So in that occurrence, it's like, well, then the users essentially own the block space.
Well, so here's something I want to pose, because this is where the question kind of comes about, is so, because staked, how I look at it is that, well, staked ETH, like you have to stake it in order to vote, do all this other stuff, right? But counter argument, that's the same as giving your stocks to BlackRock to proxy vote for you. It's the exact same thing. You're going to hold the stock anyways, but you don't want to make the decision, and you're going to leave it up to an expert to make the decision. So like with Lido Pool, Rocket Pool, and all these other guys, you're letting them do all the hard, heavy lifting. Meanwhile, you just hold and benefit that way. And so, but again, these stocks end up being securities. And so this question comes up, and this question I've been kind of grappling with because clients have been asking me. I wanted to pick your guys' brains. Are a lot of these tokens that are proof of stake, are they definitely securities? Because one, they have some centralized, like Ethereum has Vitalik Buterin, right? So back when it was proof of work, at least it was more decentralized in that case. But now it's clear that Vitalik, even though he's whatever the founder, he's calling the shots, right? They're calling the shots that way. And so is proof of stake, did that securitize Ethereum? Because now you have, this perpetual liability sitting on the Ethereum protocol that, whether or not people get their staked ETH unlocked is completely dependent on if they actually make the upgrade happen, right? So it's kind of sitting in this perpetuity. And if they don't, then you have to continue to build out services like we are today that are able to, monetize it to a better extent, I guess, to, unlock the liquidity in your ETH. So it's been something I've been trying to grapple with. I wanted to see, what you guys kind of really think about all that. It's just an interesting thought. So it's like, maybe we shot ourselves in the foot.
Yeah, I mean, maybe for the time being, but then what do you think like staked ETH looks like in the situation that it is unlocked? Oh,
Yeah. So in the event that it is unlocked, I mean, still, if you are taking your staked ETH and then giving it to, say, Rocket Pool or Lido, right, to run the node, okay. Well, now you have the exact same situation that we have in the traditional financial industry when you buy a stock through like an investment advisor and you say, I want proxy voting, or you buy a stock through a mutual fund or an ETF, and you've agreed to proxy voting, so they're going to handle all the heavy work for you, right? All you have to do is benefit from the financial benefit you get the financial benefit for a fee, right? But that stuff, that's a security at the end of the day. And so like Rocket Pool, for example, would technically be a security. All those things would be a security because of how the service is offered. So that like, I start looking at it that way, and it poses an interesting situation.
Right. Yeah, that's definitely an interesting question. I need to spend time thinking about that.
I know. That's why I asked. Like, so if you view block space as a commodity, that is the true commodity. Monetizing that would be interesting, because now you got something that you can say, well, there's limited amount. The only way that you can change block space is by like having a technological change, right? Which is the same with like most mining. The only way to increase the supply of gold is to find more gold, but you have limited gold at the end of the day, or you manage to make a better process at refining gold. So
yeah, interesting.
Yeah.
I actually have to jump, guys. Are we?
Yeah. I think we
good enough to work with.
Yeah. Okay, so I guess we'll close out with one question, not financial advice. Do we short, max short, 100x short into January or not?
I mean, depends.
Isn't there like a seasonal theory with that though? Like in December around the holidays, you should, because markets kind of just like shut down. People
not
are enjoying the time.
Yeah, I mean, there's it's just illiquid around the holidays, right? People are off celebrating Christmas and New Year's and getting drunk. I can tell you, I'm going to be mentally checked out after the 20th. But it's from the 20th to the 3rd, I'm going to be mentally recovering. But it's Yeah, they're that's why they call it the Santa Claus rally. But at the same time, with the Santa Claus rally, Christmas comes in red and green. So I think it's a good time to like reposition a portfolio. I think it's a good time to kind of plan what you're going to do for the next year. Depending on how the Fed communicates today, which I'm going to be watching closely, that's what's going to kind of set my vibe for 2023. Because what I'm waiting for is clarification whether the theme is officially recession or still inflation. If we head into the recession theme, right, go ahead, short tech, short all that stuff. Like everything's coming down. If you want to buy stocks, go ahead and buy healthcare, tobacco, alcohol, that type of stuff. Because when people lose money, they get depressed. And you know what they do when they get depressed? They go to their vices. That's how I would trade it. I have a great little graphic I could send to you guys if you want.
Yeah. That'd be amazing.
Yeah. But that's my vibe on it. It's still too early to tell, unfortunately.
Okay.
Yeah.
That's a good way to close out then. Okay. Thanks everyone.
Yeah,
Thanks.
Thank you.
Thanks BLK. Thanks Mitch.